It's no secret the world has a serious inflation problem. In the United States, we're seeing prices of things hit 40-year highs, and we're not far off from that in Australia. To fix this, central banks are raising interest rates. The idea is that when rates go up, money becomes more expensive to borrow, people stop spending, and prices stop going up. Inflation drops. The only thing is that raising rates can cause a whole bunch of new issues, including a stock market crash and even a recession. So in this video, I'm going to run through what history tells us about how the stock market performs during a rising rate, high inflation environment. Because while it can be a nerve-wracking time, environments like these can also be a good opportunity if you know where to look. Before I go on, this is not financial advice. Everyone's investment journey is different, so seek advice if in doubt. I'd also like to thank our sponsor Go Markets, the share trading platform that offers CHESS-sponsored Australian shares at a very low rate of $7.70 per trade. You can check them out on the link below. So straight off the bat, the stock market tends to perform worse when interest rates are rising. That's why whenever there's a prediction that rates will go up, you'll tend to see stock markets fall almost immediately. The reason for this is that when interest rates go up, companies are forced to borrow at a higher price and their existing debt becomes more expensive. And since the same thing is happening to the whole economy, they're probably selling less goods and services, or at least at a lower price. This all has a negative impact on company net profits and their ability to grow. You'll notice that when interest rates are low, companies tend to do a lot of growing, and the inverse is also true. Adding inflation into the mix makes things even more complicated. As you probably know, high inflation is bad news for the economy. If left unchecked, it could lead to rising unemployment and, worst case scenario, a severe recession. Rising interest rates are supposed to curb inflation, but we're not sure how quickly that will happen. Prices are pushed up in part thanks to Russia's invasion of Ukraine and bottlenecks in supply chains from COVID-19. And these are events we don't have much control over.
Inflation, it's looking like it is going to be with us for a while. I mean, I think that one of the best predictors is the bond market, and they're predicting that the RBA is going to kind of top out their rate hike cycle around June next year. So that, by extension, you'd think would mean that inflation will be with us for that long.
So let's look at what history tells us about these two conditions. Bearing in mind that just because it's happened in the past doesn't mean it will happen again. Australia's central bank is forecasting inflation to rise above 6% this year and to sit above the benchmark 2 to 3% range until at least mid-2024. At the same time, the RBA has indicated it's likely to continue raising interest rates. This combination of rising interest rates and rising inflation is often associated with an economic condition called stagflation, where prices rise even as the economy continues to slow. The reason stagflation is so devastating is that an economic slowdown typically leads to rising unemployment. That's made even worse because money starts to lose value as prices continue to soar. Historically, this is a pretty rare scenario. The last time we saw consistent yearly rate increases alongside rising inflation was in the 1970s. Between 1970 and 1975, the inflation rate in Australia rose from 3.78% to a whopping 15%. To get inflation back under control, central banks, including the Fed and the RBA, delivered multiple rate increases. This resulted in variable mortgage rates in Australia doubling in a matter of years, from around 5% to over 10% by 1975. And the Australian All Ordinaries Index responded as you might expect, with heightened volatility as investors sought to work out what it all meant. Over the 5-year period, the All Ords ended the year down by more than 20% on 3 separate occasions. Despite a couple of impressive rallies during that time, the index was down over 14% from 1970 to 1975. From then until around 1990, inflation rose and fell on and off but stayed relatively high. And interest rates were the same, with mortgage rates hitting a record high of 17% in the late 80s. While this might all sound like bad news for the stock market, Australia's market actually performed pretty well over the long run. Despite a few significant crashes over this period, Australia's All Ords Index rose by over 330% from 1975 to 1990. The reason you can expect so much volatility is that higher interest rates aren't actually bad news for every sector. For instance, banking and financial institutions can do better when rates are higher because their profit margins are bigger. This is an important consideration because Australia's stock market is uniquely heavy on banking and mining stocks. And mining and resource stocks, funnily enough, can also perform well in a high inflation environment because commodities prices are higher.
I would suggest that the resource stocks will outperform still, even in this environment. Commodity prices aren't coming down for anytime soon by the looks of it. The other essentials, healthcare, I think will normally is immune to inflation. Consumer staples, such as the supermarket giants, the stuff that you can't live without. Look for stocks that pay big dividends. They're the ones that you can sit out when they're going down a bit because you know you're getting paid still.
At the other end of the spectrum, we can expect the worst performing parts of the market to be in growth and technology. You've probably noticed that shift happening already. Year to date, the ASX 200 index, which consists mostly of banking and mining stocks, is down less than 10%. Meanwhile, the tech-focused Nasdaq in the US is down around 30%. Part of the reason for this is that growth stocks tend to rely more on borrowed funds than, say, a bank or a well-established mining company. And for companies that aren't yet making a profit at all, like, say, Uber, rising interest rates are especially detrimental.
The companies that really rely on that high future earnings, and when those future earnings are in doubt due to higher interest rates, they're the ones that take the brunt.
Assets with a long duration to profitability suddenly become worth less today in a higher rate environment because they largely rely on borrowed funds to continue growing. So during a rising interest rate environment, you'll typically see investors move funds out of growth stocks and into income-earning blue chips. This is especially bad news for the tech-heavy Wall Street, but Australia, for better or worse, doesn't actually have a lot of tech stocks, comparatively at least. As I mentioned earlier, we have a lot of companies that don't do too badly in a rising rate, higher inflation environment. So while the stock market in general is weighed down by the slowing economy, major portions of it may actually be pushing in the opposite direction and dragging the markets up. It's this weird balancing act that makes it so difficult to predict.
When there's this volatility, this uncertainty, there's some very good opportunities. I mean, you could see 2020, if we get anything similar to that, it was a buying opportunity.
That's it from me. Thanks for watching the video. And if you want to see more like this, don't forget to hit the like and subscribe button. I'd love to hear from you. What are you planning to do with your portfolio over the next few months?